This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're going to go through question 3 of the December 2009 paper F9 exam. So make sure you've got the question in front of you, and as always, look first of all at the requirements. Part A, calculate the theoretical exrights price per share after the rights issue, 4 marks. We haven't read the body of the question yet, but in principle that should be pretty straightforward, and it's purely calculation. B, evaluate the effect of the European investment on earnings per share and wealth of the shareholders. Assume that current spot rate, that's worrying, and earnings from existing operations are both constant, 9 marks. And note it says evaluate, so it is really just arithmetic, but it does mean comparing. We haven't read the body yet, but always when it says earnings per share and it says evaluate, it's basically saying what are the earnings per share now and what are they going to be in the future. Part C, 4 marks. Explain the difference between transaction risk and translation risk, illustrating your answer using the information provided. We've got to illustrate using the information provided, but the basic difference, that's very, very textbook, so it's something you should have learned. And finally, part D, the 6-month forward rate, the 12-month forward rate. We can earn interest, we can borrow. Identify and briefly discuss exchange rate hedging methods that could be used. Provide calculations that illustrate 2 of the hedging methods you've identified. I think we already know which 2 we're going to be looking at, since they've given us forward rates and money market interest rates, but 8 marks. So let's have a go. First of all, part A, the theoretical exrights price after the rights issue. We better have a look at the body of the question now. We've exported goods to Europe. We plan to increase our market share. The investment will cost 13 million and is to be financed by equal amounts of equity and debt. So I'll just jot down information as I come to it. So we're going to raise equity. Equal amounts, so euros 6.5 million and debt 6.5 million. Again, euros. The return in euros before interest and tax is forecast to be 20%. The debt finance, I'm not too worried for the moment, we're in this rights issue. And here we are, the equity finance will be raised in dollars by a rights issue in the home country. So it's going to be raised in dollars. So raised from the rights issue, we need to get, where are we? It's $6.5 million, euros rather. We know the exchange rate on the last line. There's 1.3 euros to the dollar. And so 6.5 divided by 1.3, it's going to be $5 million. That's what's needed for the investment. There are issue costs though, so we need to add on the issue costs. If we need 5 million actually for the project, then we're going to have to raise a bit more. So 0.312 million. So a total 5.312 million. And that's how much we need to raise. The rights issue price will be at a discount 17% to the current price. And the current price is $4. So the issue price, a discount of 17%. So $4 minus 17% of $4 gives an issue price of how much? $3.32. And so, how many shares are we going to issue? We're going to raise 5.312 million. It's $3.32, the issue price, and so the number of shares we'll be issuing is 1.6 million. Which is a nice number, which gives me some confidence that we're going the right way. Well, I think now we've got everything we need, because the current shares, existing shares, how many have we got? The market capitalization is 100 million. The current share price is $4 a share, so we've 25 million shares at $4 each, 100 million. I don't know why that happened, and I'm sorry. We're going to issue new shares, the rights issue. In total, an extra 1.6 million, and the total we're going to raise, 5.312 million. And so, in future, we're going to have 26.6 million shares, and in theory, for no gain, no loss, this should be worth 105.312, and therefore the theoretical exrights price $105.312 divided by 26.6 million is how much? $3.96 per share. So there's part A. I think that's rather tough for 4 marks. There's nothing technically hard, but there's quite a lot to do there because of the change of currency and so on. I think it's a bit of time pressure. Anyway, let's carry on. What about part B? Evaluate the effect on, first of all, the earnings per share. Well, always when he says evaluate the effect, remember we're having a new investment here. So we need to know what's the current earnings per share and what will it be after we've done this new investment. So the current earnings per share, that shouldn't be too much of a problem. How can we get that? It doesn't tell us what the current earnings are, but look at the paragraph next to the end. We pay tax at 30%, currency is the dollar. The current price earnings ratio of the company, which is not expected to change, note that, is 10 times. So currently, the market value is 10 times the earnings. We know what the market value is at the moment, it's $4. And so currently, if the market value is $4 and that's 10 times the earnings per share must be $4 divided by 10, 40 cents. So that's not a problem. But what about the new one? Well, the new earnings per share, we're going to have more shares in issue, obviously, because of this rights issue, but we're going to get more earnings because of the new project. So, what are the current total earnings? Currently, we worked out earlier, we've 25 million shares in issue. We're earning 40 cents per share. And so currently, 10 million. because of the new project, we're going to get extra earnings. Incidentally, I better keep track of the currency. I'm working in dollars here, appreciate. So the extra earnings, the first paragraph I'd already noticed, we knew the investment was costing 30 million euros and the return before interest and tax was 20%. So 30 million euros, convert to dollars, I'm working in dollars, remember. So it's $1.3 to the euros to the dollar, $10 million, 20%. So 10 million, 20%, that's an extra 2 million earnings. However, that's the earnings before interest and tax. So there'll be extra interest payable. Half the money came from debt. It was a 6.5 million bond issue. So 6.5 million, but again in dollars, divide by 1.3. And the interest we're paying is 8% a year. So 6.5 million divided by 1.3, there's 5 million at 8%. There's 0.4 million interest, giving us 1.6 million before tax. Finally, though, there's going to be extra tax payable. The tax rate, I saw it somewhere. There we are. Paragraph before the end, NG pays tax at 30%. 30% of 1.6 is 0.48, meaning the extra earnings available for shareholders is 1.12 million. And so, what are the new earnings per share? Total earnings, 11.12 million. The total shares in issue, we worked out earlier. Here we are. After the rights issue, we've now 26.6 million. And so, the earnings per share, $0.418. Now, it doesn't ask us to comment. All right, it's gone up. It was 0.4, it's 0.418. If there was a comment, that's on its own is good. But no, I'm wasting time. What about part 2, though? The wealth of the shareholders. Now then, be careful here. The theoretical exrights price I'll do it per share here. We worked out earlier, theoretical at $3.96. And remember that had it been $3.96, the theoretical price, there'd be no gain, no loss for shareholders. Now he wants to look at the effect on the wealth. So if the new market value is $3.96, there's no change in the wealth. But what we need to know, what is the actual new market value per share? And how can we do that? Well, it does say, where are we? Again, the paragraph just before the last one, the current price earnings ratio, which is not expected to change, is 10 times. So with a P of 10 still, the market value will be 10 times the new earnings per share. We'd worked out the earnings per share, 0.418. And so it'll be $4.18. And so if there was no gain, no loss, $3.96, it's actually going to be $4.18. And so the effect on the wealth, there's a gain to shareholders of the difference, which is how much? 22 cents per share. Now, I have a feeling he left it as per share. You could have said the total gain. Well, how many shares are there? We'd worked out there are 26.6 million shares in total. They're gaining 22 cents, and so the total gain as a result, 5.852 million. So that bit not too bad. B part 1 took a while, but B part 2 fairly quick. But as always, if you'd got part 1 wrong, you'll get a different answer for part 2. Make sure you show your workings properly. You won't lose marks twice as long as you're doing the right thing on your figures. Part C. This should be relatively easy. The difference between transaction and translation. Transaction risk that's the risk due to exchange rate movements on actual cash transactions. Now it says to illustrate using the information provided. Well, the only actual cash transaction really that we know about is this interest on the bond issue. Remember, our home country, we work in dollars. We've raised money in euros. The interest, therefore, is payable in euros. And so, although it's fixed in euros, as exchange rate changes, the actual dollar cost to us will change. So, the example here, the interest payments are being made in euros. What about translation risk? Well, what this is that when we consolidate accounts, remember we're in dollar land, but we're investing in euro land. And so when we come to consolidate, the assets and liabilities in euros will need converting to dollars. And of course, they will change as exchange rate changes. And in fact, I've done both. I mean, I've explained what it is, described it, explained the difference. The information provided, well, there we are, the assets and liabilities. It's this new investment. It doesn't actually ask for, but it's worth mentioning that because there's no actual cash effect, the financial manager is less concerned. It's only effectively book gains, book losses as exchange rate changes. Finally, part D. Identify and briefly discuss exchange rate hedging methods that could be used by NG. Now, it's slightly loose here because we've invested in Euroland. We know we're going to have to pay this interest. in euros. So we know there is risk there. Also, though, of course, presumably, we've got lots of other costs and possibly revenues in the foreign country. We invest in this storage, packing and distribution network. And so we could be at risk there. So the trouble is we don't know no information about it. So we really have to concentrate on this interest payable, which is at risk. And so how could we go about hedging against that risk? Well, it's worth mentioning netting. We could have open a euro bank account and keep euro transactions separate. So any euro receipts we've got, use the euros to make the euro payments. We'd only be at risk on any balance that came in or out of dollar land. The other specifically, though, we could use forward rates. He effectively tells you, he's given us forward rates in Part D. We could use the money markets. Again, he's given us the interest rates. So we've already got a couple of marks there suggesting. He said, provide calculations that illustrate two of the hedging methods. Well, he only wants illustrating here, so we don't need to go to great lengths. The way I'll illustrate, we're paying interest at 8% a year. It's payable in euros on a 6-monthly basis. So, my illustration. I'll take the interest payable in 12 months' time. And how much interest is payable? We've raised 6.5 million euros. The interest is 8% a year, but it's payable on a 6-monthly basis. So the interest payable in 6 months would be €260,000. Now, he only says to illustrate, so I mean, you could have done the interest in 6 months' time. Doesn't matter. But there's no need to do both. So let's illustrate what we could have done. If we do nothing at all, of course, then the amount we'll pay in dollars could be anything. It depends what's happened to the exchange rate in 12 months. However, if we use forward rates, the 12-month forward rate is 1.2752, so it'll mean we need to pay €260,000 converted at 1.2752 dollars to the pound. Which is 203,890. And prove you understand how they work. Remember, that would be fixed in 12 months' time. You don't convert any sooner, but if you've gone for that forward rate, you have to convert. I'll write that down as well. You must convert at that rate. It's an obligation, there's no choice. So whether the spot rate in 12 months is better or worse is irrelevant. It's fixed at 203,890. On the other hand, if we use the money markets, in the money markets, remember, forget forward rates. The only way we can be certain is to convert money now. But it's pointless converting the whole amount now. since we don't need to make the payment for 12 months. And so what we're going to do, we will convert now, but whatever we get, we'll deposit euros for 12 months. In order to have, 260,000 in 12 months. And the reason we won't need to convert the whole amount is, of course, we'll be earning interest at, what's the rate? We can earn 2.8% per year. It's 2.8%. So the amount we need to deposit, if we're earning interest, we'll deposit a bit less than 260,000. Divide by 1 plus the interest rate. 260,000 divided by 1.028. 252,918. Now, so if you remember, there are 3 steps. There's step 1. That's the amount we'll need to deposit now at fixed interest. And in 12 months' time, we'll have the amount we need, 260,000. We'll need to buy the euros now at today's spot rate. Well, today's spot rate is $1.3 to the euros to the dollar. So 252,918, 1.3. And so it'll cost us $194,552 now. However, that would mean paying out money now, whereas, of course, the interest itself we wouldn't normally be paying for 12 months. And so we'll borrow those dollars for 12 months. So the actual payment will be in 12 months' time. We'll have to pay interest, of course. And the interest borrowed short-term in dollars is 5.3% per year. And so the amount owing in 12 months, 194,552, add on the interest, 1 plus R, and so what will it cost us? 194,552 times 1.053, 204,863. And that will be a fixed payment in 12 months' time. Now, although I have actually answered the question, we've now finished, make sure you are clear what's happening. As of today, there's no net cash flow. We borrow money, we immediately convert it, we immediately deposit it, so there's no net cash flow. But in 12 months' time, we'll have to pay out that much, 204,000. And in 12 months' time, the deposit matures and 260,000 euros come out, which can go to the debt lenders. Also, just compare out of interest. Had we gone for forward rates, it'll be 203,890, fixed in 12 months. Had we gone for money markets, 204,863. Well, he doesn't ask here to say which would be best. So here I am wasting time. We have finished the question. Here, since we're paying money, forward rates would be better. The reason I did have a quick check, though, is I'd never expect them to be massively different. If they were massively different, then I'd be worried that I made a mistake. And okay, I've done my workings nicely, so any arithmetical mistake will only lose me half a mark here and there. But even so, had they been a lot different, if there was time left at the end of the exam, then I'd go back and I'd be checking my arithmetic. But here, they're near enough. There's no obvious reason they should be wrong. Okay, there we are.